welcome to Griffonomics.
Imagine, for just a second, deciding to build a massive state-of-the-art manufacturing facility
Right.
to build highly classified missile components for the United States government.
Not exactly a small undertaking.
No, not at all. Now, imagine footing the bill for that entire expansion completely yourself, out of pocket.
Just writing the check.
Exactly. And doing it based on nothing but a contingent handshake from the Pentagon.
Wow. And today, we are looking at a company trading at a massive 400-to-1 price-to-earnings ratio that is doing exactly that.
Yeah, they really are.
So whether you are an institutional investor, managing a high-growth aerospace portfolio, or maybe an industry analyst trying to track the shifting tectonic plates of the defense sector.
Or even just someone who's insanely curious about the hidden sort of bare-knuckle financial mechanics of national security.
Exactly. We are thrilled you are joining us today because we are setting our sights on a company that is fundamentally reshaping how the U.S. defense industrial base operates.
Karman Space Defense.
Right, trading under the ticker KRMN.
The overarching narrative here, it's nothing short of a radical industrial transformation.
Yeah.
We're looking at an enterprise that has strategically evolved from being this fragmented, relatively anonymous sub-tier parts supplier into what is now functionally operating as a Tier 1 national security prime.
Which is a huge leap.
It's massive. And understanding how they pulled that off requires looking at the actual mechanics of their business model.
Right.
It's a massive shift in how they execute contracts, how they interact with the Department of Defense, and I'd argue, more importantly, for anyone listening today, how the public market is really struggling to value them.
Okay, let's unpack this.
Yeah.
Because the sheer scale of the numbers and, frankly, the complexity of the contracts we are looking at today are just staggering.
They really are.
Our mission for this deep dive is to tear into their blistering Q1 2026 financials. I mean, they posted an incredible 51% year-over-year revenue growth.
That's top-line growth.
Right, top line. And we need to dissect this highly touted $151 billion SHIELD IDQ contract they recently secured a position on.
A very coveted position.
Plus, we have to put their recent announcement of a $1 billion quote-unquote contingent demand pipeline under a serious forensic microscope.
Absolutely necessary.
And lastly, we are going to analyze their massive leadership pivot. They brought in heavy-hitting executives from Lockheed Martin.
Right.
And we need to see if that's substantive or, just window dressing for Wall Street.
Well, the stakes for understanding Karman right now could not be higher.
Yeah.
To truly grasp what's happening with this stock, you have to look well past those flashy top-line growth numbers.
That's 51%.
Exactly. You have to weigh the gritty actual mechanics of defense contracting.
Which is not always pretty.
No, it's things like undefinitized contracts, brutal political gridlock in Congress, and, the agonizing operational reality of corporate integration.
Integrating new companies.
Right. You have to weigh all of that against a staggering valuation. I mean, at a 400-plus PE ratio, perfection isn't just expected.
Right.
It is mathematically priced into the stock. Any slight deviation from perfection, any delay in Washington, and that valuation becomes incredibly fragile.
If you're looking at that 400 PE ratio right now, you're probably thinking, this stock is priced for absolute perfection.
And you'd be entirely right.
Yeah. So let's look at what happens if they miss a single step. But to do that, we first have to understand how they're even in the conversation for these massive multi-billion-dollar contracts today.
Because Karman didn't just stumble into these wins.
Right. Over the past few years, they've methodically engineered this nearly impenetrable competitive moat. They call it their concept-to-production model.
And that is the engine driving this whole story.
So I want to break down what it actually takes to build a missile interceptor today, because from my understanding, the old way of doing it is just a logistical nightmare.
Oh, historically, the defense supply chain has been incredibly fragmented, which naturally creates massive inefficiencies. So let's look at how a prime contractor, someone like a Lockheed Martin, a Boeing, or a Raytheon.
The big guys.
Right. How they traditionally build a missile. They don't just build every single piece in-house.
Obviously not.
No, they have to manage dozens, sometimes hundreds of sub-tier suppliers, and that's just for one subassembly.
That's wild.
Think about it. One boutique engineering firm designs a component.
Okay.
Then a completely different material science lab tests the alloys.
Right.
Then a third, highly specialized manufacturing shop actually mills the metallic housing.
Sounds exhausting already.
It gets worse.
Ah,
A fourth company, perhaps located entirely across the country, handles the high-temperature composite resins.
okay.
And finally, a fifth vendor provides the energetics,
Energetics
the
B.
explosive elements or the actuators, the things that actually make the parts move or separate in flight.
So every single time you hand a highly sensitive, classified part off from one specialized vendor to another,
You're introducing massive friction.
right, you're adding weeks of transit time. You're adding shipping costs, insurance costs.
And crucially, you're adding multiple points of potential failure in quality control.
Oh, man. So if the metallic housing from vendor 3 has a microscopic flaw,
Right, and it doesn't interact well with the composite resin from vendor 4.
the prime contractor is just left trying to figure out who to blame.
Exactly. While the entire multi-million-dollar missile program just grinds to a halt.
That sounds like exactly the pain point Karman recognized.
It is the exact pain point. What they have done, largely through a very aggressive, highly targeted acquisition strategy over the last half-decade.
They bought up a lot of companies.
Right. They've unified all of those disparate capabilities under one roof.
So when they say concept to production,
They mean they have brought design engineering, rapid prototyping, rigorous environmental testing, and both low-rate and full-rate production together.
all in-house.
All in-house. Their materials science competencies run incredibly deep now. We are talking about advanced metallics, high-temperature composites that can actually withstand atmospheric re-entry,
Wow.
specialized resins that don't degrade under extreme stress, and, of course, the internal energetics required for modern rocketry.
You know, I often hear people compare this to the culinary world.
Oh, really?
Yeah, like it's like a restaurant deciding whether to buy flour, yeast, and water from 3 different farms to bake bread
Ah, I see.
versus just buying the absolute perfect loaf from a master baker who has the only recipe. Why risk changing bakers?
It's a fun analogy, but it feels a bit too simple for what's actually happening on these factory floors.
Fair enough.
Karman isn't just baking the bread, they are literally genetically engineering and patenting the yeast.
Oh, wow.
And they're building specialized ovens that literally no one else has.
Okay, let's go with that. Let's look at the actual manufacturing floor to see why that proprietary capability matters.
Well, take something like electron beam welding.
Electron beam welding.
Right. This isn't just soldering 2 pieces of metal together in a garage.
I would hope not.
Electron beam welding involves shooting a highly concentrated beam of high-velocity electrons at a target.
Okay.
But it has to happen in a complete vacuum
A complete vacuum. Why?
because the kinetic energy melts the materials together with extreme precision. And you need that precision when you're working with exotic aerospace alloys like titanium.
Because titanium would be contaminated by the oxygen in the air.
Exactly. Building a vacuum welding chamber, maintaining it, and training engineers to use it.
Let me guess, it's not easy.
It's incredibly difficult,
Yeah.
especially to do it without introducing microscopic impurities that could cause, say, a rocket nozzle to just shatter under thermal stress.
That makes sense. And a prime contractor would much rather pay Karman a premium to handle that headache than try to build a vacuum welding chamber themselves.
Precisely.
But how does that convenience translate into the kind of economic moat that justifies a 400 PE valuation?
Wow.
Because convenience is great, sure, but prime contractors are notoriously aggressive negotiators.
Very aggressive.
So if someone else figures out how to electron beam weld titanium slightly cheaper, why wouldn't the prime just switch vendors?
Because Karman's moat transitions from just being highly convenient to being virtually impenetrable through the strategic use of intellectual property.
Okay.
Karman isn't just waiting for a prime contractor to send them a blueprint and say, build this.
They're not just order takers.
No, they are actively collaborating with the primes extremely early in the design phase. We're talking years before a weapon system ever goes into production. They use their own design intellectual property, their proprietary IP, which includes patented components,
Right.
and their process IP, which involves those unique manufacturing methods we just discussed, like the specialized spin forming and composite layups.
Oh, I see where this is going. When you use your own proprietary tech to design a solution for a prime contractor's new missile,
Yes.
your specific technology literally gets baked into the final production specification.
That is the crucial mechanism. This gives Karman what is known in the defense industry as sole source status.
Sole source.
Right. Once a new missile system is rigorously qualified by the Department of Defense.
With Karma's parts inside it.
Exactly. With their proprietary composite interstage or energetic actuator inside it, it becomes incredibly difficult, almost impossible, to remove them from the program.
Because requalifying a new supplier in the defense sector isn't like, changing the brand of tires on your car.
Not at all.
The switching costs are astronomically high.
Yes, they are.
If a prime wants to kick Karman out and use a cheaper vendor, they have to prove to the DoD that the new vendor's part won't cause the missile to explode on the launch pad.
And that proof requires millions of dollars in new testing, years of bureaucratic paperwork.
And a massive amount of risk for the prime.
What's fascinating here is that the switching costs effectively lock Karman into long-term sole source contract positions that can last for the entire life cycle of a defense program.
Which is how long, usually?
In the aerospace and defense space, a program life cycle can be 20, sometimes 30 years long.
Decades.
Once you are designed in, you are in for decades.
Wow.
This is precisely the playbook executed by commercial aerospace consolidators like TransDigm.
Build the moat?
Right. You build a technological and operational moat so deep, backed by proprietary IP and massive requalification hurdles, that the prime integrators are functionally reliant on you.
You transition from being just a vendor to becoming an indispensable partner.
Precisely.
Okay, so we've established that Karman has engineered an indispensable, nearly impenetrable moat on the factory floor.
They have.
But building that moat is just the prerequisite for the real prize. Wall Street isn't valuing them at a 400 PE just because they're good at welding titanium.
No, they are not.
They're valuing them based on the sheer magnitude of the defense projects they are now invited to participate in. In January 2026, Karman announced that its Systema facility, which, by the way, they strategically acquired back in 2021, was awarded a contract under the Missile Defense Agency's SHIELD IDQ.
And the scale of this contract vehicle represents a massive strategic inflection point for the company.
Huge.
SHIELD stands for Scalable Homeland Innovative Enterprise Layered Defense.
That's a mouthful.
It is, but it's the primary procurement mechanism for what is conceptually known in defense circles as the Golden Dome Initiative.
The Golden Dome. I mean, it sounds like something out of a science fiction novel.
It really does.
But it is the literal, physical layered homeland defense architecture being constructed to protect the United States from advanced ballistic and hypersonic threats.
That's exactly right.
And Karman isn't just providing generic hardware for this architecture. They are providing the absolute critical sensor and interceptor subassemblies.
Critical pieces.
We're talking about payload protection shrouds, the highly complex aerodynamic interstages.
Which allow the different stages of a missile to separate flawlessly in flight.
While traveling at Mach 5.
Right, while traveling at Mach 5. And the actual propulsion systems.
The technology is fascinating, but for the investor or analyst listening, the financial structure of the SHIELD contract is really what demands attention.
The dollar figure attached to this vehicle is a staggering $151 billion shared ceiling.
Wait, $151 billion?
Yes, but to understand the financial implications of that number, we have to contrast how an IDIQ works versus a traditional defense contract.
Okay, and IDIQ stands for Indefinite Delivery, Indefinite Quantity, right?
Correct.
Let's break that down. Because a lot of people see $151 billion in a press release and assume Karman just got handed a check for that amount.
Which is absolutely not the case.
It's a shared ceiling among multiple contractors.
That is a vital distinction. Historically, the government might use a traditional fixed-price contract for a major program.
Okay.
Under a fixed-price contract, the supplier agrees to build a set number of systems for a rigid, predetermined dollar amount.
Which sounds safe, right?
Well, let's look at what happened during the post-COVID inflation crisis.
Right.
Companies holding massive fixed-price defense contracts were absolutely decimated.
Because if the price of aerospace-grade aluminum doubles.
Exactly. Or if raw material supply chains break down, or if specialized labor becomes 30% more expensive.
The government doesn't care.
The government doesn't care at all. The contractor agreed to the fixed price. The supplier is forced to absorb every single cent of those cost overruns.
And their profit margins simply evaporate.
It is an incredibly risky mechanism in an unpredictable macroeconomic environment.
Right. But the SHIELD IDQ is different. It's a shared ceiling structure.
Very different.
It isn't tying funding to a single, rigid, long lead time program with a fixed price tag determined years in advance.
Oh.
Instead, it creates this massive $151 billion funding umbrella.
Exactly.
And the Missile Defense Agency can issue rapid, specific task orders under this umbrella.
The task order mechanism is really the key to agility here.
How's that?
As threat environments evolve, say, an adversary develops a completely new hypersonic glide vehicle.
God forbid.
Right. The Missile Defense Agency doesn't have to spend 3 years drafting a new fixed-price contract.
They can just move fast.
They can simply issue a task order under the SHIELD IDQ to the pre-approved vendors, like Karman.
To rapidly develop and deliver a countermeasure.
Yes. It fundamentally changes the risk profile for a supplier. It protects them from massive long-term inflation traps.
That makes sense.
And accelerates their ability to generate revenue from emerging national security crises.
But, to navigate a $151 billion Pentagon procurement vehicle, you can't just operate like a scrappy sub-tier parts supplier anymore.
You certainly cannot.
You are playing in the absolute major leagues now,
Right.
which requires major league talent in the boardroom.
Yes.
So, in March 2026, Karman appointed a new CEO, John Rambeau.
A very notable appointment.
And shortly after, Rambeau brought on Doug Laurendeau to be the chief growth officer.
This is what the industry refers to as the Lockheed effect.
Because of their background.
Exactly.
Yep.
John Rambeau is a 26-year veteran of Lockheed Martin. He didn't just work there. He managed massive, complex portfolios.
Like what?
We're talking integrated warfare systems, missile defense, radar systems, and even parts of the F-35 international program.
Wow, okay.
And Laurendeau also brings extensive Lockheed Martin pedigree. This is a massive, deliberate signal to the market, to the Pentagon, and to the prime contractors.
Like sending a message.
Bringing in big prime leadership is designed to demonstrate that Karman finally has the corporate maturity and the institutional gravitas to operate as a Tier 1 systems provider.
I understand the signaling value. I really do. But I have to push back here.
Go ahead.
Wall Street loves a Lockheed pedigree, but you cannot build interceptor missiles in a boardroom.
True.
Does bringing in big prime leadership actually change the operational reality on the factory floor? Or is this purely a cosmetic reshuffle to justify that 400 PE ratio?
It's a fair point.
I mean, are they just putting fancy new name tags on the exact same manufacturing processes and hoping investors don't notice?
It is a highly necessary question, and honestly, any analyst looking at an executive pivot should inherently be skeptical of moves that look like pure window dressing.
Right.
However, Rambeau actually addressed this exact skepticism during his first earnings call in Q1.
What does he say?
When analysts asked him what he planned to overhaul, he explicitly pushed back against the idea of ripping up the current playbook or changing the factory floor protocols.
Okay.
He stated, and I quote, "I believe Karman's strategy is working well, so I don't see a need for substantial changes in strategy or the trajectory of the company."
So he's essentially saying, the engineers and the machinists are doing a phenomenal job. I'm not going to tell them how to weld titanium.
That is the exact translation. This executive pivot is absolutely not about changing how they electron beam weld a shroud or how they lay up composite materials.
They already know how to do that.
The engineers have that locked down. This pivot is entirely about navigating the uniquely labyrinthine Department of Defense procurement cycles.
Politics.
Exactly. It's about having the established relationships, the political savvy, and the strategic foresight to sit across the table from four-star generals and prime contractor CEOs.
Speaking their highly specific language.
To ensure Karman captures the maximum possible share of that $151 billion SHIELD task order flow.
So the executives are playing three-dimensional chess in Washington and on Wall Street.
They are?
But while they are doing that, the physical reality of the factory floor actually is changing in a massive way to handle the sheer volume of these incoming contracts.
It has to.
Right. Because Wall Street expectations don't physically manufacture hardware. Let's look at the actual infrastructure scaling. Because Karman is currently undergoing a massive 200,000 square foot expansion at their Salt Lake City facility.
This expansion is a massive capital bet.
Championed by their chief operating officer, Jonathan Rambeau, right?
Yes. The new Salt Lake City footprint is targeted to reach its initial production capability in the fourth quarter of this year, 2026.
Coming up quick.
And it's crucial to understand what is actually going inside that 200,000 square feet. This isn't just generic warehouse space to store extra inventory.
Right.
They are specifically ramping up highly specialized manufacturing capacity for rocket nozzles and UAS launchers.
UAS unmanned aircraft system.
Exactly.
And this ties directly into the broader geopolitical landscape we are watching unfold globally right now.
Without a doubt.
The nature of modern conflict has fundamentally shifted toward unmanned systems, drone swarms, loitering munitions.
We're seeing it every day.
We're seeing an absolute explosion in the demand for these platforms, and Karman is positioning itself to be the primary launch provider for them.
And building a launcher for a loitering munition isn't simple.
Right.
You need highly reliable pneumatic or electromagnetic catapult systems that can deploy these drones instantly in austere environments.
Wow. But you know what stands out to me? It's COO Jonathan Baudouin's specific phrasing during their updates.
What did he say?
He explicitly stated their philosophy is to maintain capacity ahead of customer demand.
Ahead of demand. That is a phrase that inherently polarizes financial analysts.
How so?
Well, it makes the growth-focused investors incredibly excited, and it makes the risk-focused accountants incredibly nervous.
Let me dive into the financial mechanics of that. Because building capacity ahead of demand, here's where it gets really interesting.
Okay.
It is essentially building a massive, state-of-the-art championship stadium before your team has even officially made the playoffs.
That's a great way to put it.
You are banking entirely on the fact that the fans are going to show up and the tickets will sell. But from a pure corporate finance standpoint, the way Karman is executing this is fascinating.
It is.
Because they aren't diluting shareholder equity to pay for this stadium.
Right.
In an environment where a lot of high-growth companies would just issue a massive secondary stock offering to fund a 200,000 square foot expansion.
Which crushes the value of existing shares.
Right. But Karman is avoiding dilution entirely.
The balance sheet management here is critical for justifying their valuation.
Let's hear the numbers.
If you look at their liquidity profile at the end of Q1 2026, Karman was sitting on $74 million in cash and cash equivalents.
That's a solid chunk of change.
It's a massive jump, up $40 million just from the end of 2025.
Wow.
And on top of that cash buffer, they have a recently upsized $150 million revolving credit facility.
A revolver.
And CFO Mike Willis went out of his way to explicitly state on the call that this revolver is completely untapped.
An untapped revolver is a massive weapon in this interest rate environment.
It provides immense optionality. When you consider that their projected capital expenditures, their CapEx for the entire fiscal year of 2026 is expected to be roughly $36 million.
The math is incredibly clear.
Very clear.
They have $74 million in cash on hand, plus $150 million in untapped credit. They have more than enough liquidity to easily fund this $36 million, 200,000 square foot expansion.
Without having to issue a single new share of stock.
So they have the cash to build a stadium. They aren't begging the market for money?
They aren't. However,
The catch.
the analytical counterweight must be applied here. Funding the expansion is only half the equation.
Right.
Building ahead of demand is a brilliant market-dominating strategy if the orders actually materialize on time.
If the fans show up.
Right. If the contracts hit exactly when the factory opens, you look like a visionary CEO.
You capture market share instantly.
Because you are the only supplier in the country with the physical capacity to deliver. But it carries immense operational and capital expenditure risk.
Because what if they don't show up?
If those government orders are delayed by even 12 months, or if they don't come at the volume anticipated, you are left holding the bag on a massive, empty, climate-controlled facility.
Just sitting there.
The depreciation expense, the property taxes, and the maintenance costs of 200,000 square feet of idle aerospace manufacturing space. It will act like a lead weight on their profit margins. It is a high-wire act with zero safety net.
Yeah. Which brings us perfectly to the core tension of this entire story. They have the cash, they are building the factory, and they have the big prime executives.
Yes.
But are the actual fans going to show up to sell the stadium? Are the orders guaranteed? Let's perform a deep forensic analysis on what they are calling their paper backlog.
We have to read the fine print of their corporate disclosures with absolute precision here.
Let's do it.
On May 12, 2026, Karman dropped a massive announcement that really caught the market's attention.
This was the billion-dollar announcement.
Yes. They stated they had officially received $1 billion in multi-year contingent demand commitments from 4 of their major prime contractor customers.
Tor primes.
Right. And they were very careful to note that this $1 billion is in addition to their officially reported, audited $1.0 billion firm backlog.
So on the surface, the headline reads like they have $2 billion in total future revenue locked up in the pipeline.
That's how it reads?
And the source of this new $1 billion contingent demand is incredibly specific. It's tied to the highest priorities of the Pentagon.
Driven largely by the Munitions Acceleration Council, or MSC.
Right, the MSC. For those who aren't steeped in defense procurement, the MSC has designated a highly specific list of 14 priority weapon systems.
And these are being fast-tracked for immediate production and massive stockpile replenishment.
We're talking about the absolute heavy hitters of the U.S. arsenal.
The programs underlying this $1 billion figure are as structurally solid as they come in the modern defense world.
What are they?
The demand is specifically tied to systems like TIDE.
The Terminal High Altitude Area Defense System.
Exactly, which is critical for intercepting ballistic missiles. It is also tied to PAC-3 interceptors, the advanced munitions used in the Patriot missile battery.
Which have been in the news a lot lately.
Right. It includes the venerable Tomahawk cruise missiles, the GMLRS guided rockets utilized in the HIMARS systems.
Which have proven so critical globally.
And the brand new PRSM, the Precision Strike Missile. Karman has been tapped by these 4 prime contractors to provide the proprietary subassemblies for these exact systems over a sustained 4 to 7 year delivery period.
From a technological and geopolitical standpoint, those 14 MAC priority systems are virtually bulletproof.
Absolutely.
The U.S. military absolutely needs them, and they need them yesterday. But I have to play the skeptic here. Because this is exactly what the short sellers and the bears are screaming about.
Let's hear it.
The underlying programs are great. But the word contingent is doing an unbelievable amount of heavy lifting in this announcement.
It certainly is.
This $1 billion pipeline is not firm backlog. It cannot be legally recognized as revenue. A contingent handshake sounds great in a press release, but isn't this essentially just paper backlog?
Yeah.
If the Department of Defense doesn't get the funding, these multi-year minimum order volumes just evaporate, right?
It's a very formal, legally drafted handshake with multi-year minimum order volumes specified in writing. But yes, you are correct. It is fundamentally a handshake until certain mechanisms are triggered.
Let's look at those conversion triggers. What actually has to happen for this $1 billion paper handshake to convert into firm funded backlog that Karman can put on its balance sheet?
Okay. For this to become real money, Karman's prime contractor customers, the Lockheeds and Raytheons of the world, they must first receive funded, definitized contracts from their end customer, which is the U.S. Department of Defense.
Okay.
And on the commercial space launch side of their business, the primes must finalize and lock in their actual launch schedules.
Right.
Until those highly specific triggers are pulled by the DoD, Karman cannot officially count on a single dollar of that $1 billion.
And this is where the macro-political risk crashes headfirst into Karman's microeconomic strategy.
If we connect this to the bigger picture.
Yeah, if the Department of Defense doesn't get the funding approved by Congress, these multi-year minimum order volumes just evaporate into thin air.
Right.
The massive new Salt Lake City factory stays empty, the depreciation drags down earnings, and that 400 PE ratio absolutely collapses.
You are hitting on the exact systemic risk that hangs like a dark cloud over this entire sector. We have to look at the harsh realities of the fiscal year 2027 defense budget process.
What is the reality?
The president's budget request asks for massive, almost unprecedented multi-year procurement jumps.
Okay.
They are asking for an 8-fold increase in funding for TAE and PAC-3 interceptors.
8-fold.
Yes. They are asking for funding to nearly quadruple the production of the Precision Strike Missile.
8-fold increases. That isn't just a bump for inflation. That is a generational surge in industrial demand.
It is a staggering request, but a presidential budget request is merely the opening bid in a notoriously partisan, highly protracted congressional appropriations process. As an impartial observer of the legislative landscape, it is simply a historical fact that the United States government frequently, almost routinely, fails to pass its full budgets before the fiscal year ends on September 30th.
We see it every year.
When Congress deadlocks, they resort to passing continuing resolutions, or CRs.
And a continuing resolution is pure poison for a growth company like Karman.
Pure poison.
Because under a CR, government agencies are legally forced to operate at the exact same funding levels as the previous fiscal year.
Yes.
They are statutorily prohibited from starting new programs. And crucially, for Karman, they cannot drastically ramp up production volumes on existing ones.
That is the exact trap. If there's political gridlock in Washington and Congress relies on a 6-month continuing resolution.
That 8-fold increase for Theater production gets put on ice.
Right. The prime contractor doesn't get the surge funding. And because the prime contractor doesn't get the funding, they cannot legally pull the trigger to convert Karman's contingent demand commitments into firm orders.
So Karman's entire $1 billion pipeline
And their state-of-the-art 200,000 square foot facility
could be trapped in legislative limbo for months, purely due to congressional dysfunction.
Exactly.
Waiting on Congress to pass a budget is a dangerous, unpredictable game.
It is.
But if there's one thing Karman's executive team has proven, it's that they refuse to sit still while Washington debates. To keep that 51% revenue growth rate alive during this legislative limbo, they aren't just building internally.
No, they are actively buying revenue.
Right. In January 2026, Karman closed a major strategic acquisition, buying Seemann Composites and MSC. This was a highly aggressive move.
Very aggressive.
A $210 million cash and $10 million stock transaction.
Mergers and acquisitions are the absolute lifeblood of Karman's expansion strategy. And it's vital to point out a highly favorable financial detail of the Seemann and MSC acquisition.
What's that?
There are 0 earnout liabilities attached to this deal.
Let me add to that, because the absence of an earnout is huge. Often, when a company buys another, they structure the deal with contingent future payments based on the acquired company hitting certain revenue targets over the next few years.
Right, which creates risk.
Those earnouts hang over the balance sheet as liabilities.
Right.
By paying $210 million in cash up front with 0 earnouts, Karman has a clean break.
Yes.
They own the cash flow immediately without worrying about future hidden debt obligations to the previous owners.
It is a very clean acquisition structurally, and the strategic alignment of buying Seemann and MSC is brilliant.
Why?
By integrating these high-end composite manufacturers, Karman instantly created a brand new maritime defense segment for their overall business.
Oh, wow.
Literally overnight, they diversified away from being purely an aerospace and missile company, and the impact was immediate.
What were the numbers?
In Q1 2026, that brand new maritime defense segment made up 17% of their total revenue.
17%. So it tapped Karman directly into the U.S. Navy submarine programs.
Yes.
Specifically, the highly classified Columbia and Virginia-class submarines.
Right. Submarines require immense amounts of advanced composite materials, specifically for acoustic dampening, to maintain their stealth capabilities.
And if we look back at that FY 2027 budget request we were just discussing, while missiles might face gridlock, submarine programs are universally recognized as a critical priority.
Yes, they are.
The budget calls for a massive 30% jump in submarine funding, moving from $23 billion up to over $31 billion.
And John Rambeau explicitly noted on the earnings call that this specific acquisition strategy drove roughly half of Karman's total 51% year-over-year revenue growth in the first quarter.
On the top line, the buy, build, and integrate strategy is working flawlessly.
It really is.
They bought Seemann, integrated the submarine revenue, and posted a massive beat. But we are required to look at the operating margins.
We are.
And we have to address the dark side of this hyper-aggressive M&A strategy.
The bear case.
The bear case. Because acquiring highly specialized defense companies at this velocity causes severe operational friction. When I look at their operating expenses, it looks like they're suffering from severe corporate indigestion.
Indigestion.
Yeah, like eating a massive protein-heavy meal to build muscle quickly. Yes, you're gaining mass, but your body has to work twice as hard to process it, and it's exhausting.
That's a good way to look at it.
Trying to merge 2 distinct aerospace companies is like trying to perform a blood transfusion between 2 completely different species while they're both running a marathon.
Oh, wow.
You have incompatible software, radically different cybersecurity compliances, completely different localized factory floor cultures, and disparate HR systems.
The blood transfusion metaphor is actually quite apt when you look at the IT and compliance requirements in the defense sector.
Yeah.
If Karman buys a composite company, they have to ensure that the newly acquired company meets the DoD's stringent cybersecurity maturity model certification, or CMMC.
That sounds expensive.
Upgrading legacy IT systems to meet those national security standards costs millions of dollars and requires massive administrative oversight.
Right.
The top-line revenue growth from Seemann looks spectacular, but the expenses required to integrate those distinct corporate cultures and IT systems are brutal.
Just brutal.
In the first quarter of 2026, Karman's general and administrative expenses, their G&A literally doubled.
Doubled. A 100% increase in administrative overhead in a single quarter is a massive hit to the operating structure.
It is a flashing red warning light for anyone modeling their future cash flows.
Yeah.
Integrating high-end, complex composite firms like Seemann and MSC is a monumental task on its own.
Right.
But Karman's management team is attempting to execute this integration while simultaneously trying to scale their legacy operations to handle the massive $151 billion Shield IDQ task orders.
And managing the construction of a 200,000 square foot facility expansion in Salt Lake City.
The operational risk of trying to juggle all three of those massive initiatives at the exact same time is immense.
So if their G&A costs continue to outpace the revenue scaling, their overall profitability will tank, regardless of how many billions of dollars in revenue they bring in the door.
Exactly. The market will not tolerate a company that buys revenue at the cost of its operating margins.
Especially not at a 400 PE valuation.
Not a chance.
And internal corporate friction isn't the only risk threatening their profitability. There is a hidden, highly complex contractual risk baked directly into exactly how they do business with the Pentagon.
Yes.
I was digging through their SEC filings, and there's a specific clause that jumped out at me.
The UCAs.
Yes. The filings explicitly note that Karman occasionally operates under what are called Undefinitized contract actions, or UCAs.
Right.
To me, starting work without an agreed price sounds like corporate suicide. How is an undefinitized contract even legal in public procurement?
It is a highly nuanced but absolutely critical aspect of defense contracting. It rarely makes it into the headline press releases, but it can devastate a company's bottom line.
Explain how it works.
Undefinitized contract actions happen when the U.S. government, almost always in response to an urgent national security requirement or a sudden geopolitical crisis, directs a company like Karman to begin manufacturing work before the formal negotiations regarding pricing, exact engineering specifications, and legal terms are actually completed.
Right, really.
The government essentially says the warfighter needs these interceptors immediately. Start building them today, incur the costs, and we will sit down and figure out the exact price and profit margin up to 180 days from now.
So they are burning their own cash, using their own labor to build a product for the government without knowing what they will ultimately be paid for it.
Yes.
So what does this all mean? This is like eating a 5-course meal at a restaurant where the menu has absolutely no prices.
Right.
And the chef legally gets to decide what to charge you after you've finished dessert and the doors are locked. That is terrifying for profit margins.
That analogy captures the exact financial peril of what the industry calls unilateral definitization.
Unilateral definitization.
During that undefinitized period, Karman is incurring millions in material and labor costs. Eventually, the contracting officer sits down to audit those costs and negotiate the final price. Okay, if Karman and the government cannot agree on what a fair profit margin should be, or if the contracting officer decides Karman paid too much for their raw titanium and disallows the cost,
Oh, no.
the government has the legal authority to unilaterally dictate the final terms of the contract.
And unless Karman wants to engage in a multi-year, highly public legal battle with their single largest customer.
They are legally obligated to accept those dictated terms and perform the work.
Wow.
Exactly. And the government is not in the business of unilaterally granting defense contractors 40% profit margins.
Right.
Unilateral definitization almost always results in highly unfavorable pricing for the contractor, disallowed costs that the company has to eat out of pocket, and burdensome administrative conditions.
So it eats into the profits.
It can severely compress the profitability of the work Karman has already committed resources to performing.
But they have to do it.
While UCAs are an absolutely necessary tool for the Pentagon to maintain agility and respond to rapid national security crises, they are a massive blind spot for investors looking at Karman's backlog.
Those contracts represent an invisible structural risk to future earnings.
Exactly.
When you stack that invisible UCA margin risk on top of the M&A indigestion that doubled their G&A, and then place all of that underneath the broader political risk of a congressional budget stalemate,
It paints an incredibly complex picture for anyone holding this stock.
It really does.
We must continuously revisit that FY 2027 budget stalemate risk. It's not taking a political side to state that the United States budget process is historically unreliable.
True.
If continuing resolutions freeze the MSC priority contracts and delay the conversion of that $1 billion contingent demand pipeline, Karman's future revenue stream is directly threatened.
Absolutely.
Now, to be entirely fair to their management team, Karman has robust mitigation strategies in place.
Like a cash buffer.
Exactly. They are intentionally keeping that $74 million cash buffer specifically to survive periods of delayed government payments.
Okay.
And they purposefully maintain a highly diversified base of over 130 active programs across space, maritime, and missile defense.
So if Congress cuts funding to one specific program, it doesn't sink the entire enterprise.
Exactly. But the systemic risk of relying on the United States government as your primary source of revenue is always present.
Which means the broader market might finally be waking up to these invisible risks.
It might be.
We've laid out the entire narrative. The impenetrable vertical integration mode, the massive $151 billion SHIELD task orders, the stadium-sized factory expansions ahead of demand, the M&A blood transfusions, and the political UCA traps.
Right?
This leads us to the ultimate question of this deep dive. Are they the next TransDigm, or are they Icarus?
To answer that, we have to summarize the absolute dichotomy of their Q1 2026 financial performance because it left analysts completely divided.
Give me the good news first.
On one hand, you have a business firing on all cylinders operationally. They confidently raised their 2026 full-year revenue guidance to up to $735 million.
Awesome.
They officially crossed a record $1 billion in firm definitized backlog.
Even better.
And because of that massive backlog, management stated they have a staggering 90% revenue visibility for the entire year.
90% visibility.
Most aerospace CEOs would practically kill for 90% visibility in the first quarter of the year.
It is an absolute dream scenario for financial forecasting. The revenue is virtually locked in. But on the other hand, immediately following this massive earnings beat, a raise in guidance and the announcement of the $1 billion contingent pipeline, the stock plummeted 11% in after-hours trading. 11%. On a massive beat and raise.
Yes.
If 90% revenue visibility, 51% year-over-year revenue growth, and a billion-dollar firm backlog aren't enough to satisfy Wall Street, what possibly could be?
It's a great question.
I mean, is Karman destined to be the next TransDigm of missile defense, a relentless compounder that mathematically dominates its niche for decades? Or are they Icarus, flying way too close to the sun with a valuation that is structurally bound to melt the second they hit a political cloud?
Let's unpack the concept of valuation fatigue.
Okay.
The answer to that 11% drop lies entirely in that 400-plus price-to-earnings ratio.
Right.
When a stock is priced at a 400 multiple, you are not just paying for their current 51% growth. You are paying for absolute flawless execution a decade into the future.
Flawless.
The market sold off the stock because when an asset is priced for absolute perfection, even a phenomenal top-line revenue beat isn't enough to satisfy the high-frequency algorithms and the institutional risk models.
If there are underlying operational risks beginning to surface in the margins.
Exactly. The bears looked past the 51% revenue growth and saw the G&A expenses doubling from the M&A indigestion.
That is precisely what happened. They saw the operational friction eating into the bottom line.
And crucially, institutional investors read the fine print on the $1 billion contingent demand announcement.
They realized it was contingent.
They realized that a massive chunk of Karman's future growth narrative is entirely reliant on a gridlocked Congress passing unprecedented generational defense budgets on time.
The market is essentially saying, we love the company, but we refuse to pay a 400 multiple to take on congressional budget risk.
Yes.
So what is the final verdict for the investor or the analyst trying to model this out?
This raises an important question. My synthesis of all the data, from the factory floor to the balance sheet, is this.
Okay.
Karman's fundamental business model, their proprietary technological IP, and their operational concept production moat are exceptionally strong.
Unquestionably.
They are successfully verticalizing a fragmented, highly inefficient supply chain, and the Department of Defense desperately needs them to succeed.
Right.
However, the stock and the company are currently entirely decoupled.
The underlying company is fundamentally strong, building critical infrastructure. But the stock price is completely exhausted by its own expectations.
The company itself is a transdeme in the making. It is rapidly building an indispensable sole source position in national security.
Right.
But the stock is priced exactly like Icarus. The ultimate test for this enterprise isn't going to be engineering a more heat-resistant rocket nozzle or a better composite submarine hull.
No.
The ultimate test will be whether CEO John Rambeau and his Lockheed pedigree executive team can successfully navigate Washington, integrate their acquisitions without destroying their operating margins,
And convert that $1 billion paper handshake into firm, definitized, highly profitable contracts before the market completely loses its patience with the valuation multiple.
It is a relentless race against the market's sky-high expectations, and the clock is ticking.
Which brings us to our close.
I want to leave you with a final thought to mull over, looking well beyond just Karman's balance sheet to the broader implications for the United States as a whole. Consider what it truly means that our national security apparatus is increasingly relying on contingent demand.
Scary thought.
We have a defense industrial base where critical prime contractors and essential sub-tiers like Karman are being asked by the government to privately finance massive factories.
Like the 200,000 square foot Salt Lake City plant.
Based purely on non-binding handshakes while they wait for months on a gridlocked Congress to appropriate the actual funds.
Right.
What happens to our sovereign national readiness if a sudden massive geopolitical shock hits during a budget stalemate?
Wow.
And these critical factories aren't fully operational because the contracts were undefinitized and the funding was trapped in committee. Are we effectively outsourcing our sovereign national security risk to corporate balance sheets?
It is an incredibly sobering question, and it completely reframes how we must look at these record-breaking defense contracts moving forward. The risk isn't just financial, it is structural. Thank you for joining us on this exhaustive deep dive into the mechanics, the money, the politics, and the moat of Karman Space and Defense. Risk defined, portfolio protected,